Okay, and again, the recap that we're doing is from today, which is Wednesday, September the 21st, 2011, and this is called a multiple recap. We're doing a step-by-step recap of everything that we've covered today. The first thing that we start with is identifying the direction of the market. Now, we identify the direction of the market using the large trigger lines. The first thing we do is identify whether our price action is above or below the large trigger lines. When our price action breaks below the large triggers, I'm going to draw just a red vertical line. And all that red vertical line shows is that we have broken below the large trigger lines. I'll draw a blue vertical line when the price action begins to break above the large trigger lines. Now, what I'm going to do is I'm going to draw a red and blue line every single time we break above or below the large triggers, regardless as to what the chart reads, just to show you direction and area first. So here we've closed below the triggers, here we've closed back above. I'm going to scroll the chart forward, and again you can see we've closed below the large trigger lines. If you want to use that one as a close above, I'm okay with that, and then it goes right back below. And what you're going to see is a lot of arrows, or I'm sorry, a lot of vertical lines drawn on the chart. For those of you that like to draw the vertical lines on your chart, I recommend starting with blue and then going to red, because when you draw a vertical line on your chart as blue, when you want to draw a red one, you just double click onto the line, click onto the color, and hit the letter R, and it'll jump right to red. If you hit blue, there's a few different colors that pull up before it actually changes to blue. So it's an easy way to quickly change the color of your vertical line from blue to red just by clicking on the letter R. Okay, there's really a lot of different points in which I can put it in here, and you know what, I'm going to do every single one of them, and I'm going to do it right because I just want to show every single close above or below the large trigger lines. And you can see where a lot of them occur, and when you see a lot of closes above and below the trigger lines, what happens is your large triggers will become flat. Your large triggers will start to become flat with all of the closes above and below the trigger lines. Okay, almost done, so give us just a minute. I'd say that's actually pretty accurate when it comes to the closes above and below the trigger lines up to this point, up to the current market. Every single time we've closed above, blue line. Every single time we've closed below, a red line has been drawn. Now what we're going to do is we're going to scroll the chart back, and we're going to start filtering some of these lines out. Now in order to filter the lines out, the first thing we're going to look at is our 5-minute chart. Our 5-minute chart will be the first actual chart that we look at. And what I'm going to do is what's called a global crosshair. A global crosshair will allow me to put a crosshair on my tick chart. At the same time, it'll put a crosshair on my 5-minute chart. So take a look at your 5-minute chart right here when the direction of the market changed to the downside. If you look at where the 5-minute chart is, your 5-minute chart, small triggers and MACDs are crossed to the downside. Now if I scroll forward right up to this point, you can see that not only are we closing above the large trigger lines on my 576, but I'm also closing above my small trigger lines on my 5-minute chart, and my MACDs on my 5-minute chart are beginning to weaken and roll. Now as we scroll the chart forward, you see where this red line is? Because now we've closed back below the large trigger lines. You see that red line? We've closed below the large trigger, so it looks as if the direction of the market is turning to the downside. But if you look at where your 5-minute chart is, your small triggers are wide and spread apart to the upside. Your MACDs are strong to the upside as well. The Bollinger Bands are wide and spread apart, and the MACDs are outside of the upper Bollinger Band, which represents strength and momentum. So while the direction of the market may change to the downside here on the 576, we would never want to fight the strength and momentum of my 5-minute chart. So this red line gets erased. So does the next blue line, because the direction of the market is strong up on the 5-minute, which means we can either look for long trades or we will not look for shorts. We can have longs but not shorts, so really that one blue line can stay. As we scroll the chart forward again, you see this red line as well. Still have strength and momentum in my 5-minute chart. So I can delete that red line and the following blue line. When you see this red line, notice that this red line, you're closing below the small triggers, the MACDs are beginning to roll. So that red line will keep. You see the blue line? When you have the 5-minute chart with strong small triggers, strong MACDs, you don't want to try to fight or counter it. If they're weak MACDs, weak small triggers, you can go with whatever direction the 576 tick chart will point in. So if it's up, it turns up. You see it turns up, down, and it weaves in and out of the large triggers for a bit. Finally, the direction of the market changes to the upside. You have to keep in mind that this little chop right here was right in front of news. So that's okay, because sometimes the direction changes very quickly when it comes to news. And then again, we'll come back to it. Now you can see here the directions, we're going to keep them up. We're going to keep them there. Now take a look at this one here. The direction of the market changes to the upside. But look at your 5-minute chart. Small triggers open to the downside. MACD starting to go strong to the downside as well. So in these cases here, we can actually start erasing all of these lines here. We can erase them all. Because when the direction of the market changed to the downside, your 5-minute chart gained strength and momentum to the downside. And right here, look, we have support. Start to close above the small triggers. Doesn't matter. We do not want to fight or counter the strength and momentum of our 5-minute chart. So each time I put that line on the blue line, if I see on my 5-minute chart that my small triggers and MACDs are strong down, I can erase all lines, because that means the only thing we could possibly look for would be short trades and not longs. Now take a look at this blue line. Closing above the small triggers, MACDs are starting to roll. You may want to move it over just a little bit. So when the MACDs actually roll right here, you may want to move it over a little bit, where the MACDs literally cross that lower Bollinger Band. But at this point, the direction can stay up. Now, if it turns up, it's up. Turns down, it's down. Because now, again, you have 5-minute small triggers and MACDs. 5-minute small triggers and MACDs are now weak. And as long as they're weak, we can go with whatever direction the 220 tick chart points. I'm sorry, the 576 tick chart points. And here, direction changes up, it goes down. Look at when it goes back to the upside. We can see that our 5-minute small triggers and MACDs started to gain a little bit of strength, so we'll actually eliminate those two lines and leave this one when we start closing above the small triggers and getting the MACDs to roll back up on our 5-minute chart. Okay, now we've eliminated a lot of the lines. We've eliminated a lot of the lines using our 5-minute chart. So now we can turn the global tracking off because we no longer need to recap using our 5-minute chart. In reality, we have during the live market, we have both charts side by side, so we don't need the global tracking on, but for the recap purposes we did. And now we're going to scroll it back one more time and do one more direction. This time we're going to incorporate the next two steps to see if the direction of the market truly changes. Now for this, the first step that we've covered so far has been direction, which is based on our large trigger lines. We're now going to incorporate the next two steps, which is areas followed by risk to reward. Area, because it can be singular. And we're going to follow that with risk to reward. Okay, right there, risk to reward. So we're going to follow it with this. So now we're going to try and incorporate all three to really determine if our direction truly changes. We're going to look at all three: direction, area, and risk to reward. Now, the direction of the market changes to the downside. We have areas that we could go short from. We have areas that can hold the market down and would give us room to a target. We could go short from the mid-band and the large triggers and have plenty of room to get to the lower outer bands and the support. When the direction of the market changes to the upside, plenty of areas that can hold the market up and that could get us up to the upper outer bands and resistance. So in those cases, we'll leave the lines. Direction turns down, a lot of areas that could hold the market down and push the market to the lower outer band and back to support. When the direction of the market changes to the upside here, same thing. Areas that we could trade long from, areas that we could trade short from. So we'll leave all of those lines there. The types of lines that we're looking to eliminate are lines like these two. You can see the direction of the market changes to the upside. The question is, which areas can you go long from that would give you a good risk to reward? Are there any areas that you can trade long from that would give you room to a target area? You can see the direction is up, but it's pretty high above the mid-band, which means you could only look to go long from the large trigger lines. It's not going to give you too much room to the resistance area or the upper outer bands. Not to mention, by the time you pull back to an area that you can trade from, direction immediately changes to the downside. So again, it leaves two lines that you can eliminate. The more obvious ones are when the direction changes and there's no areas that you could possibly trade from that gives you a decent risk to reward. Like this one here. Direction changes to the downside, but there's no areas that really you could trade from that gives you room to the lower outer bands, to give you room to a target. So while the direction of the market changed to the downside, really there were no areas that you could trade from to go short. So you could eliminate the red line and just keep the blue. Now, that's all there is when it comes to direction. Granted, we broke it out a little bit, so you can see a few of the different ways that we look at the direction. We look at the direction, and we use the 5-minute chart. Look at the direction, making sure we have areas to trade from that give us a good risk to reward. So just a couple of added things as opposed to just simply the large trigger lines. Okay, when the direction of the market is down here, this is a little bit pre-market, but you can see that the areas that can hold the market down are the large triggers in the midband. So each time it pulls back towards the large triggers in the midband, they act as areas that can hold the market down. When the price action pulls back to the upper Bollinger Band, that will also act as an area for down. So it started the morning a little bit pre-market, but it's set up for a couple of short trades. From the large triggers and midband, areas that you could trade short from. That gives you room to a target, room to go down to the lower outer bands and support. When the direction of the market changed to the upside, we could go long from the midband. Once again, we pulled back to the midband. Once again, we pulled back to the midband and the zero line. So not only did we have direction, but we had areas that could hold the market up and give you room to target areas, the upper outer bands and resistance. When the direction of the market changed to the downside, the large triggers can hold the market down, so can the midband. Direction of the market changed to the upside. You could look to go long from the large triggers and midband. As it pulled back, it changed the direction. So while the direction was up, you pulled back to an area for up and changed the direction in the process. So direction turned down. Now you could look to go short from where? Maybe the large triggers on a pullback, and again, you pull back to the large triggers and you break above. You pull back to the midband, you break below. So each time you tried to retrace to an area, the direction of the market changed. So in this area, there would simply be nothing to do. You'd be looking for a trade setup, but not one would happen. When the direction of the market changed to the downside, large triggers in midband could hold the market down. Direction changes up, the midband could hold the market up. And here, the direction of the market changes to the downside. Actually, we were looking for a short from the large trigger lines, but as we retraced to the area, we broke above. 5-minute was still strong down. Once we broke below the midband, once we broke back below the zero line, it gave you an opportunity to take the short. Direction was down. We used the midband as an area for down with room to continue to the downside. We pulled back up to the midband, the zero line, with the large trigger still strong to the downside. The midband and large triggers acted as an area for down. Each time we pulled back to the midband, it was an area to re-enter into our short trade, still expecting the market to go down to the lower outer bands and supports, because those are our target areas. As you pulled back to the midband, the last two times, the midband and then the large trigger lines, the MACDs pulled up to the upper Bollinger Band. Now this is where direction of the market is still down because our 5-minute is strong down. But we just pulled back to the area of the midband, the only area for down, but you'll notice that when we pulled back to the midband, we had kind of overran it. That's why there's no short trade marked here, because we overran the area. Not to mention we were coming off of a support line. So we waited. And again, direction of the market changed up on your 576, but was still strong down on your 5-minute chart. So when you see the direction and you know it's down because the 5-minute is strong down, look, there are no areas that you can go short from. The midband's an area for down, but it puts you into the large triggers. Resistance is an area for down, but that puts you into the midband and then into the large triggers. So it doesn't really give you an area to go short from until you break back below the large trigger lines. Then the midband and large triggers can hold the market down. When the direction changes to the upside, you could have pulled back towards the midband and large triggers for an area for up, but in this case it just kind of kept going and never came back. When the direction of the market changed to the downside, you pulled back to the large triggers, which is an area for down. Same goes for the upper Bollinger Band, which is also an area for down. You have the dual bar reversals to the downside. If you wanted to wait for it to get through the midband, waiting for it to get through the midband is fine as well. Wait for it to get through the midband to get through the fib. Pulls back, here it's through the midband, the fib, and the zero line rejection to the downside. Direction turns up. The large triggers is an area for up, so is the midband. We were looking for the trade from the large trigger lines, but we didn't have an area in the MACDs. We didn't reach the lower Bollinger Band as we reached the upper Bollinger Band in the previous short. And you can see how direction and area Direction is up. These are the areas that can hold the market up. The mid-band, the large trigger lines. You can see how the areas tend to cause bounces and hold the market to the upside when the direction is up. Right now the direction of the market is down. You can see the areas causing bounces to the downside. Resistance, the large triggers, and if you break through the mid-band, you'll have the mid-band as well. So since we have gone through and we know the direction, the areas, the risk to reward, we know the direction of the market, we know the areas that we could trade off of that go with the direction, we know the risk to reward is good from those areas. Now all we have to do is look for an entry, right? That's it. Look for an entry. And your entry is going to be based on your small triggers and your MACDs. Your small trigger lines represent the immediate direction in the market. Your MACDs help to understand momentum of the current direction of the market. If you pulled back to the mid-band and the large triggers here, small triggers down, MACDs down. Pulled back to the mid-band and the large triggers here, small triggers, MACDs starting to weakly turn up, but an area in price and an area in the MACDs as you retrace to the area. That means everything says down, and the only thing that says up are weak MACDs and weak small trigger lines. It allows for an entry a little bit early when you have an area in price lining up with an area in the MACDs. Here, small triggers, MACDs cross to the upside. Next one, area in price, area in MACDs. Weak small triggers, weak MACDs, and everything else says up. The entry can be taken a little bit earlier, right at the area. This one you'll notice that we made an exception. Based on the strength and momentum of our 5-minute chart, which had very strong small triggers and very strong MACDs, we recognized that we were below the large triggers, but they were still crossed up. Our MACDs turning off of the zero line, price action turning off of the mid-band, small triggers and MACDs turning to the upside. We made an exception on that one, going with the strength and momentum of our 5-minute chart, with the majority of our indicators pointing up still on our 576. Direction down. Large triggers is an area for down. So is the mid-band. Small triggers and MACDs are already crossed down. Since you're on the wrong side of the small triggers on your large trigger lines, you would have liked an area in the MACDs to be traded from. You could have taken the short as it got through the mid-band. Chops up here, preparing for news. We did have a news announcement coming out, and I think it was housing index or something along those lines. But when the news announcements come out, it can often weave in and out of the large trigger lines. No problem. Because once you identify that you're weaving in and out of the large triggers, which is a lot easier to see when you have those red and blue lines on the chart, you can easily identify that you're weaving in and out of the large trigger lines. You avoid the chop, especially in front of news. After the news announcement causes a breakout, large triggers begin to open up, then we look to trade as normal. Direction is down. Mid-band is an area for down, so is the large triggers. Small triggers, MACDs turning to the downside. Gives you an opportunity for your trend trade short. It begins to lose momentum before the target area is reached, but we still are expecting the target area to be reached. Not to mention we're gaining strength and momentum to the downside on our 5-minute chart. So we pull back to the mid-band. Strength and momentum still on our 5-minute chart. Close below the small triggers. MACDs begin to roll at the zero line, and you'll notice the small triggers really close to the mid-band, giving you a low risk on the trade. Your trend trade to the downside works up a little potential for bullish divergence. The potential for bullish divergence is merely that. It's only the potential for divergence. So we couldn't take an exit a little bit early because it's only the potential for divergence, and that doesn't mean too much at this point. If we had an area like the outer bands or the fib, we would look to exit early even without weakness in our small trigger lines or MACDs. Out in space, it's got to turn first. That's exactly what happens. Once it started to turn, we already saw the potential for divergence as the market was going down, and it became an immediate exit. You'll notice your first short is a pretty successful short. Your second one is just a small successful short. You pull back up towards the mid-band, you have an opportunity to get back in. All you're doing is re-entering into a trade that you were already in and that you were already successful on, risking some of the money that you had already risked, from your previous trades. Basically, it's as if you've entered into your first short, your first trend trade to the downside, and simply trailed your stop behind each pivot that occurred, as opposed to placing your stops behind indicators, trailing your stop behind the pivots. Why the pivots? Because if the price action continues making lower high pivots, then you're still in a downtrend. So it gives you some opportunities to re-enter and get back into the trade, to finish the move off and get you back into the support, the lower outer bands as you expect. Opportunities for re-entries only. Now here we can see direction of the market is up, but even though it's up, we know that it's strong down on our 5-minute chart. That's why we haven't seen any blue lines yet. We see a blue line, but it never pulls back to an area. We see a red line that does pull back to an area. The large triggers the upper Bollinger Band. Strong move, weak MACD reaction from support in the midband means you can anticipate the support and the midband to break. Once it does break, it gives you a trend trade short. The first one is a reversal, anticipating the downtrend to occur based on a strong move down and a weak move up. If you have a weak bounce off of support, it's expected to break and continue lower. So it does. Now that you've made lower high pivots and lower low pivots, you're in a downtrend. The midband is a great area for the downtrend to continue from, especially when it lines up with the zero line. So you have a trend trade short. The direction of the market changes to the upside. Again, strong move up, weak move down, an indication that the midband can be expected to break and continue higher. Because we did not have an area in the lower Bollinger Band, we couldn't take the entry from the large trigger lines, but after it broke through the midband and you made a higher low pivot and a higher high pivot, you're in an uptrending market and it is simply considered a trend trade. You reach resistance. Direction turns back down and back up. You have another opportunity for a long trade, for the trend trade. You even have an opportunity for a trend trade here. A little bit of caution because the large triggers were a bit flat. The market goes up to resistance. Now, when the market's out in space, floating out in the middle of nowhere, the potential for divergence is not too much of a concern. When you hit a target area, a double top with bearish divergence and a reversal bar is a concern, because not only do you have divergence showing you that you can reverse the entire trend of the market from an uptrend into a downtrend, but you have an area for a reversal to occur. Resistance, divergence, resistance, you're below the large trigger lines. That all adds up to a lot of things that say down. Take the exit, be done with the trade. When you close below the large triggers, you weaken the uptrend with the potential to turn. You have divergence, an indicator that says reversal. You're at resistance, an area for a reversal. When the direction of the market changed to the downside, it wasn't going to turn back up. Not with divergence at resistance that weakened the large trigger lines. So the direction of the market changed to the downside. So what we did here was we highlighted areas that could cause a bounce to the downside, such as resistance, followed by the large triggers, and once we break completely through the midband, we'll have the midband. Direction, area, risk to reward, and your entry. 4 basic steps that we cover in our 101 session on a daily basis. This is what we've covered today in the live market. And you can see after you separate it and you take it apart piece by piece, it becomes simpler, easier to understand. You just have to read the live market in order. Identify the direction, follow it with the area, risk to reward, and then look for an entry. And again, a brief recap of today. Today being Wednesday, September the 21st, 2011.